You know who made it.
Not dwell much there. Let me go straight into financial options. I'll give you two quotes and then we get started. Warren Buffett has said that we don't have to be smarter than the rest. We just have to be more disciplined than the rest. Incidentally, this is one area where most of us lack discipline, and especially in Africa, the desire or the ability to seek knowledge or to seek information. There are a lot of us that think we know when we don't, and a lot of us that, well, that keep hoping, or we keep doing things that we think we know, and yet we don't. Christopher Brown has also said that value stocks are about as exciting as watching grass grow. But have you ever noticed just how much grass grows in a week? Today, when I was leaving home, I worked today. When I was leaving home, I noticed how long the grass that I had cut a week ago had actually grown. And yet I've never seen it grow. A lot of us try to do investments. We try to look for excitement. When someone talks about investment, try to look for excitement. And someone said that if you're looking for excitement, then go to Las Vegas. Investment is not necessarily as exciting as sometimes we think. We want to do things that come with our world because we want to see things go up and profits coming in quickly. But things don't always work out as we expect. We need to be patient, we need to be disciplined, and we need to have a plan. And this is part of what we are going to discuss today. Okay, starting with the introduction. If we were in one room, I would have asked a question, but we don't even have the time. What's the difference between investment and gambling? That man that you see there, there's a game that they used to play in Russia, I think started World War II, called Russian roulette, where you would get a pistol, a revolver, to be exact, and you put one bullet. A revolver, I think, has a provision for 6 or 7 bullets. So you put one bullet and you roll. For those of you that watch movies, maybe you've seen that. It's a gamble. And of course, the winner would win everything. Winner takes all, and the loser dies. A lot of us do investment like gambling. Hope to survive. Investors know this is the difference between investment and gambling. And a lot of us do investment like gambling, like I said. This is the difference. Investors know how the market operates. They understand how the market operates. Gamblers, on the other hand, they have no idea, but they hope. You put in money and you hope. Some of us, for those of you that are old enough like me, you were around, or you were aware, or you were old enough to know when Stanbic did its listing. I think it was 2007 or 2006. When the shares were listed, a lot of people invested and they made a lot of money. And there was a lot of excitement on the markets because a lot of us felt that stocks are the way to go because the share price jumped from 70 shillings to 210 shillings in the first week of trading, probably in the first 1 or 2 days of trading. And so there was a lot of excitement at Binobifuna. And then fast forward, there was another IPO, I think it was for Umeme. Was it Umeme? There was another IPO. We shall talk about IPOs later. And people lost money. And people lost, because a lot of people got excited in the Binobifuna. They did investments by gambling. They were not different from that man that puts one bullet in a revolver and hopes that the bullet misses them. Are you a gambler or are you an investor? If you don't put in effort to understand how the stock or how the financial markets operate, then you won't be any different from a gambler. So we want to be different today. We want to do things differently as this class. Going to the introduction, what is a financial market? I am not going to be very technical. I'm going to use the layman's language so that even some people that might not be very familiar with some of these terminologies shall be with us. What's a financial market? Simply stated, it's any place where you trade securities, where you buy and sell securities. For example, Kalere, for those of you that are in Kampala and the suburbs, when you go to Kalere, it is a marketplace for food. You go and you buy food, whichever type. Meat Packers is a marketplace for meat. Today, when I was driving through town, I saw tile, I think it's called Tile Market. It's where they sell tiles. Financial markets is where they sell financial securities. Simply stated, what are securities? Securities are the financial options that we're going to be discussing today. I'm going to try as much as possible to use the common language. So for the geeks, the financial geeks, you'll excuse me. So financial markets are divided into two: capital markets and money markets. Capital markets is where they trade long-term securities or instruments. Instruments and securities are used interchangeably. So capital markets is where they sell long-term. And what is long-term? In the financial world, we call it long-term if it's 1 year and longer. It's short-term if it's within 1 year. If it matures within 1 year. And the market where the securities that mature within 1 year are traded is called the money market, simply stated. Please note that it is not true, not necessarily true, that money markets is where they buy and sell money. Some people think that money markets are only for currencies. No, money markets are the markets where short-term securities are traded. Remember, we said the place is called the financial market. So a financial market where short-term securities are traded is called the money market. So dividing them, I think I'll start with the money markets, then I shall go to capital markets. But for now, there are two categories of capital markets, as you can see in that picture. They are the equity securities. Equity means ownership, okay? And then debt. We shall discuss more of those. And money markets is where things like commercial papers, treasury bills, repos or repurchase agreements, etc. are traded. Okay, I'll start with money markets. Remember, we said money markets is for short-term securities. What are the options? What are the money market options that are available to you as a person, where you can put money? A lot of people ask me questions. Where can I put my money? I have some money. Where should I put it? And so today I am answering your question. And please note, we are only talking about financial markets. There are a lot of other investment opportunities out there that are not financial in nature. But today we are concentrating on financial options or financial markets or financial securities. I'll start with treasury bills. With treasury bills, you lend to government or government borrows from the public. Financial treasury bills are finance. Normally government borrows for two reasons, major reasons. Number one, to finance short-term obligations. Short-term obligations, because they are going to borrow money from you and pay it within 90 days or 180 days or 360 days. That's short-term. Remember, it's within 1 year. So the only thing that they need to finance with such money are short-term obligations. They need to pay government workers. They need to pay off some debts, blah, blah, blah. Government uses short-term securities in the form of treasury bills to pay short-term obligations. Now, reason number two why government borrows is what you call monetary policy. And central bank does this. Central Bank is Bank of Uganda. Central bank does this to regulate the amount of money in circulation so that they can mitigate or regulate the amount of inflation. You know, when there's a lot of money in circulation, then prices of commodities tend to go up. And so central bank comes in to reduce the amount of money in circulation they offer or they issue treasury bills, with the hope that when you go and buy the treasury bills, then they pick that money from you and they keep it, and then they can release it back slowly. So that's the major reason why government borrows short term. Now, to you as an investor, why would I invest in treasury bills? And these are the advantages. Number one, they are relatively low risk. In fact, greatly low risk. Let me disillusion you. It is not necessarily true that government securities or treasury securities, normally we use government and treasury interchangeably. It is not necessarily that it's zero risk, it is minimal risk. A lot of people say that these are free securities. No, it is not true, because we have seen countries that default. I think it's rare, but it happens. I think we've seen Greece and a few other countries that on their securities. There's also other risks that we shall discuss later, but it's low risk. Treasury securities are relatively low risk, because even if it's expected that even if Museveni leaves, the next president, Bobby, or whoever it will be, will have to pay. Even if probability of default is relatively low. Number two, it has minimal, they normally have minimal transactional charges as compared to some other securities where you pay a percentage of the amount of money you're investing. And the liquidity, because they are short-term in nature, you can buy a treasury bill of 91 days. Within 90 days, those are 3 months about, you have your money back. So it gives a bit of liquidity. But then there are disadvantages. Number one, they tend to give lower returns than, for example, longer-term securities. Lower returns, I mean less profit than you would probably get in a longer-term security. Number two, they're taxable. The interest that you get is taxable. They will tax you. There's also there's what you call interest rate risk. This is another risk on top of the default, the minimal default. I don't want to sound technical, but if you bought a treasury bill of 91 days today at say 9% per annum, the following day or the next 2 weeks, government normally issues treasury bills every 2 weeks, plus or minus. They could offer another bill at a higher rate, slightly higher. So you who bought before, it is considered a loss that you bought earlier or at a lower rate than someone who bought later. So there's that risk, which is a bit unpredictable. But yes, there's that risk. In case of an emergency, you can't easily retrieve your funds, except if you go to the secondary market. So that's another disadvantage. Money market number two are currencies. Now, that's where a lot of people think that these are the only money markets. Currencies are a type of money markets. Some people invest in foreign exchange. How? I won't go into the details, but normally you will buy, for example, dollars in Uganda and sell the dollars in Kenya over the internet. And you find that the rate here is lower than the rate in Kenya, factoring in the translation between Uganda and Kenya and stuff like that. That's what's called geographical arbitrage. Sometimes there are differences in prices of currencies, normally hard currency, of currencies between across regions or across various locations. So that's what we call geographical arbitrage. Sometimes people use time arbitrage, where you buy and you hold for maybe a couple of seconds or a couple of minutes, and then the price goes up and you sell. However, for the reason why most of us don't see this possibility is that without foreign exchange, when you walk into a forex bureau, there's what you call spread. You see that there's a difference between the buy and sell rate. So normally that cancels the profit that you would have made. But most of the time, the guys that do foreign exchange trading, they are not subjected to such spreads. And so there's that advantage, or there's that beauty that they normally enjoy. And that's what drives them into the market. The advantage is that they normally have extremely high returns because of your ability to buy. You can imagine you can buy dollars every minute. So if you're making, even if it was $0.5 every minute, there's a potential to grow your money quite rapidly. So there are high returns. However, as you know, very high returns normally comes with very high risk. So that's a disadvantage. It also has the advantage of liquidity. You can withdraw your money or pull out your funds at leisure because you have the currency with you. However, there are disadvantages. Number one, the high risk that I've talked about. Number two, you need to be extremely shrewd. It's a rather complex market. There are certain skills that are not ordinarily known to most of us. So it's not a very easy market to enter, especially if you do not have certain information. And most of the traders in Uganda are not regulated. And please, I beg you to be very careful when you're going into such markets. I don't do money markets, even though I do some other financial markets. I don't do money markets because I don't think I am equipped enough financially or even the skill to do this. It's not a regulated market, and so you can easily lose. I've talked to a lot of people that have lost their money trying to do forex trading. Yeah, the next is commercial paper. I will combine commercial paper with fixed deposits. What are they? Simply stated, most of you probably know what fixed deposits are. Okay, in a fixed deposit, a bank borrows from the public. You lend to a bank, and you're given what we call a certificate of deposit. That is the proof that you have lent your money to the bank. On the other hand, other companies that are not financial institutions offer commercial paper. Okay, so a company borrows from the public for on short-term basis, and then they pay back with a relatively high interest rate. And of course, commercial paper tends to attract a little high returns. These are not very common in Uganda, but yes, companies do them out there. Okay, what are the advantages of fixed deposits and commercial paper? They tend to attract higher returns than, for example, treasury bills. Why? Because if you're lending to a bank, the risk you're taking is a little higher than someone who is lending to the government itself. So the returns are a bit higher. They are also quite regulated. Commercial papers in developed countries are regulated by capital markets authorities of those various countries. Fixed deposits are also regulated because Bank of Uganda does the regulation. So that's another advantage. The risk of losing your money is a little reduced because of the amount of regulation. Not every Tom, Dick, and Harry can offer or issue commercial paper because you're borrowing from the public. They can also be used as collateral, especially fixed deposits. You can borrow against your fixed deposits. And for most, you can redeem your investments in an emergency. For most banks, you can. Some banks don't allow, but most banks do allow to redeem your money. You may have fixed your money for 3 months, and then you have a problem, you have a relative who is sick, God forbid, and so you go in, you say, okay, give me my money, even though it's not yet 3 months. Most of the time, however, you will forfeit the interest. Some banks will charge you an extra penalty, but most of the banks will just you'll just forfeit the interest that you would have got. Okay. The disadvantages include a relatively higher risk than treasury bills. I think some people seemingly lost money in Crane Bank, or the money took longer it took longer for them to get their money back, even though they had fixed it, because the bank went down. So the risk is a bit higher. Also, commercial paper, because it's offered by corporations out there, if the company dies out or fails to pay or is declared bankrupt, then you could lose your money. But like we said, it's a bit regulated. Not every company can issue commercial paper. The interest is also taxable. They will tax withholding tax. And in the event of an early redemption, I've talked about this, you will forfeit your interest most of the time, especially relating to fixed deposits. The third or the fourth, still money markets, unit trusts, or mutual funds. Some people call them unit trusts, some people call them mutual funds. In Uganda, we call them unit trusts. I think in South Africa, they call them mutual funds. This is a collective investment scheme. A collective investment scheme is a scheme that invests collectively. Sounds funny. Yeah, but it pulls money from the public and then it invests in, most of the time, they invest in securities. So they will go to Anne, to Stefan, to Apollo, to Jackie, get their money, put it together, and then invest. And of course, there's the advantage, because when they're investing, most of the fund managers are required to diversify their portfolio in order to reduce the risk. So you are investing in a fund that is already diversified. So you have an advantage that even though you come with your little 100K, it's already diversified. So it reduces the amount of risk that you bear on your 100,000. It also has the advantage of a relatively low investment requirement. You can go in even with 100K. The returns are not taxable. That is in Uganda. At least our the law, the tax regime still allows mutual funds to not be taxed. So they don't tax you, the investor. They don't even tax the fund manager when they're investing in the treasury securities. That could change in the future, but at least for now and for the last so many years I've known unit trusts, they have not been taxed, and that's an advantage. There's also the advantage of liquidity. You can withdraw your money without bearing. You can withdraw all of it or part of it without bearing any penalty, and you can get the interest up to the last date. That's another advantage. They're also very tightly regulated. That's an advantage because a company that's regulated, normally Capital Markets Authority, CMA, will make sure that the company is credible enough. They are professional enough. They manage the fund very well. They have all these layers of regulation. There's the custodian, there's the fund manager, there's all those layers of regulation that they go through. So it's not very easy to lose your money, although it's not impossible. They also have another advantage, and this is an amazing one, a compounding effect on your returns. Compounding effect means that if you invested 100,000 today and you got, say, I'm assuming you get 10% per year, that's about, I'm assuming, okay, let me assume 12% per year, that's 1% per month. So your 100,000 will probably give you 1,000, okay, every month. Or the first month you get 1,000. The second month you won't get 1,000. Why? Because even the 1,000 you got last month is also getting you another 100 shillings. So maybe the second month you get 1,100 like that. That's the compounding effect. And it's amazing how that compounding effect works. Okay, our time is fast spent. But I did the math and I realized if you invested 100,000, for example, and please, I'm not advertising any unit trust manager or fund manager in particular. But if you invested 100,000 per month at only 9%, I'm assuming a rate at only 9% per year, low as it sounds, after 20 years, you have about 67 million shillings. Do the math and see how much you will have invested. You will have invested 20 years, 100,000, that's 1.2 million times 20. That's about 24 million. The rest is interest because of the compounding nature of your investment. So it's amazing the impact of that compounding. Disadvantages, some people have claimed that the returns are a bit lower. Of course, the returns are definitely lower than active business, definitely. Slightly lower than treasury bills. Why? Because liquidity. Because you can easily withdraw your money, it means they cannot invest your money as aggressively as they would have thought. So that's a bit of a disadvantage. The other disadvantage is the element of regulation. Some fund managers have complained that because of the very tight regulation by the Capital Markets Authority, they in particular things. That's another. We don't have a fund in Uganda yet that invests in real estate. They are only restricted to investing in either treasury bills, bonds, or the stock market for the very, very aggressive investments. You can't go and invest in real estate. You can't go and invest in agriculture and what, at least in Uganda, except maybe for the exchange traded funds or stuff like that. But we don't have that yet in Uganda. I need to confirm that. The last time I checked, we didn't have such. So that level of regulation means there are some returns that you probably won't be able to get, but hey, higher return, higher risk. Yeah. Others, okay, let me skip this. I'll come back to it later. I think that those are some of the options that I wanted us to discuss under money markets. We go to capital markets. Remember, we said money markets are short-term, capital markets are relatively long-term. Now, it does not mean that you cannot retrieve your investments in a short term if you invested in the capital markets industry. No, it just means that inherently, an investor is expected to go in the capital markets when they have a long-term perspective in mind. If you go short-term, you will probably be gambling. You may Gamblers sometimes make money. You could actually make money. But if you go in with a short-term orientation, most probably you will lose money most of the time. I invested in Safaricom, and my target as an amateur investor at the time, when I invested, I had gone in short because I wanted to go. I thought it would work as Stanbic. I wanted to go in and come out. I just started investing. I was still at campus and blah, blah, blah. So I went in, I bought some shares, and I was very disappointed because within about 3, 4, 5 months, the price was lower than I bought them at the IPO. So, but in the long run, the price went up. If you do your research and you check Google, check the IPO price and compare it with now, it has gone up extremely. People have made a lot of money. But those that went in short term have lost money. Why? Because they tried to do gambling. So capital markets are majorly oriented for long-term investors, or designed for long-term investors or longer-term investors, at least within longer than a year. Number 2, they are regulated by the Capital Markets Authority. Okay, not by commercial, not by BOU, but CMA specifically. The other thing is that they can be dealt with either on the primary market. A lot of you have probably heard about the primary market and secondary market. The primary market is where you buy the securities directly from the offerer, if that word exists. The primary market, for example, for stocks is an IPO or an initial public offering. During the Stanbic IPO, Stanbic, Umeme, there was, I think, the DFC, there's the most recent one, I think it was what? Quality Chemicals, that company. The primary market, people bought shares direct from the bank. If you bought shares in Stanbic, you bought them there, you dealt with the bank sold you shares. That's the primary market. The secondary market, you don't go to the offerer. If you want to buy shares in Stanbic right now, you don't go to Stanbic Bank. No, you go to the secondary market, which is the stock exchange, USE. So you go to USE and you ask, you say, I want to buy shares, and you don't go directly to USE. You go through a broker. Those are the SOPs, so to speak. You go through a broker, and of course you pay normally. There's a charge, there's a commission that you pay to the broker. I think right now I need to be corrected, but I think it's about 2.1% of the amount you're investing. So you don't buy directly from the company, you buy from the stock market, or from Uganda Securities Exchange. USE doesn't only sell shares, even bonds, even what, as long as it's exchange traded. Securities, what are the securities that are involved in the Capital Markets Authority? We have debt securities. If you remember this, if you remember this, we had equity securities and debt securities. So I'll start with the debt securities. Debt securities, like the word says, debt. You lend to an institution, okay? Long term. If it's government, you lend to government. If it's a company, you lend to that company. Longer term. Equity securities, you own part of an institution. That's where shares come in. You own part of an institution. If it's Stanbic and you have shares in Stanbic, you're a co-owner together with the rest of the owners. Okay. So starting with debt securities, number 1, we shall start with treasury bonds. We talked about treasury bills, and we say treasury bills were short term. Treasury bonds, on the other hand, are longer term. Like we said, you're lending to government long term. Normally, government borrows this money to fund longer term projects, building roads, building dams, blah, blah, blah. So they will borrow from the public, normally at a higher rate than they would pay for shorter term securities or for treasury bills. The rate is normally higher. And normally it tends to span for 3 to 10 years or even longer. There are some bonds that are 50 years that I've heard about. I don't know if Uganda has any 50-year bond, but normally they range between 2 or 3 to 10 years. What are the advantages? Again, low risk because it's government. Number 2, there's a relatively higher return. They normally attract a higher return because they are longer term. It is expected that the opportunity cost of investing in a bond, because you're going to hold your money with government for 10 years, you could have invested that money elsewhere, or at least invested and reinvested and reinvested. So there is that element that government normally rewards longer term investors. So that's why they give a higher return. You can also liquidate your money, but only on the secondary market. Remember we said secondary market is securities exchange. You can, in a nutshell, you can liquidate your money, but only through secondary market. That's USD, you sell your shares. The only disadvantages, however, are number one, it normally, most of the time, they require a substantial amount of investment. You can't go with your 100K and you say, I want to buy bonds. Sometimes, depending on the economy you're looking at, in Uganda, I think you're required to go through a primary dealer. Primary dealers are normally commercial banks. So if you want to buy shares in, bond, if you want to buy a bond, most of the time you have probably to go through a bank, Standard Chartered, Stanbic, wherever, whichever bank you're using. Most of the banks are primary dealers. So you buy through that dealer, and most of the time the banks will set a minimum. They'll say, okay, we're only taking people that have 50 million and above, 100, 200 million and above. So you require a substantial amount of investment. The returns are also taxable. You will be taxed on the profit, on the interest that you get. There's also the element of illiquidity. Like I said, you can sell your bonds. You have an emergency, you need to liquidate, you need to pull out. You can sell your bonds, but you probably only go through a secondary market and you probably pay a commission to them. So it's a bit hard, it's a bit complex. And our secondary market is not as developed in Uganda. So most of the time you find it a bit challenging to sell your bonds if you want it, because also the secondary market is governed by forces of demand and supply. You could get less than you paid if there are no people willing to buy. Okay, you could make a loss because no one is willing to buy. Either no one has the money or no one is informed or blah, blah, blah. Most of the time there's someone willing to buy, but then sometimes you don't have someone who is willing to give you the price that you want, and those are some of the risks that people face. So yes, there's that element of illiquidity and sometimes the losses that you suffer as a result of trying to sell short or trying to sell your bonds early. Okay, still on debt securities, the other one was treasury bond. Now we talk about a corporate bond. Corporate bond, you're lending to a company. You're not lending to government, you're lending to a company. Then again, it's long-term, 3 to 10 years, even longer. Most of the time, companies will borrow shorter than 10 years. It's rare to find a company borrowing for 10 years, because even the people that are willing to lend it money for 10 years are not as many. So companies will go out, they will offer bonds, and they'll say, okay, we need people to buy. Again, you probably need a substantial amount of money to buy into that bond. The advantages are corporate bonds, of course, because the risk is higher, because you're lending an institution that could die out. They normally give a higher return in order to attract funders or investors. They will normally give a higher return than treasury bonds. You can also liquidate on the secondary market. Again, you have to probably go to USE to go to a broker and say, I have my bonds that I would like to sell. It's also highly regulated. Not every company can go and float bonds and buy and sell out bonds. You have to go through a rather very rigorous process. I think we don't have as many bonds, corporate bonds in Uganda. Why? Because of the amount of regulation that Capital Markets Authority subjects to these companies before they float or before they sell their bonds. So it's tightly regulated. That also comes as an advantage because the possibility of losing your investment reduces. It doesn't vanish, but it reduces. Those are some of the advantages. The disadvantages, of course, requires a substantial amount of investment. It has a higher risk. Company that you bought a bonds in could fail, and then you lose the money. Okay. It also has that element of interest rate risk. You could buy a bond, and then there's an opportunity. There's what you call opportunity cost. You could have bought another bond in another company. So there's always that risk that underlies all investments. The returns are also taxable. That's another disadvantage. Most of the time, they'll charge you withholding tax when they're giving you the interest they're giving you. It also has the element of illiquidity. You can only sell your bonds if you go through a broker to the stock exchange. If no one is willing, you could hold your bonds for a longer amount of time than you hoped you would. So there's that disadvantage. Okay. Like we said, there's a lot to talk about each of these topics or each of these securities, but we're just grazing over them. Going to equity securities, there's just one especially. There are others, but I'll only talk about one in detail. Shares, okay? You could buy shares. What are shares? With shares, you own a part of the company. I have shares in a couple of companies. So I am a co-owner together with 1,000 people, 1,000 other people, okay? Most of the time, or most of us know about the publicly listed companies, Stanbic, Umeme, in Uganda, Uganda Clays, and the likes, okay? What's the recent one? I've forgotten the name. So the publicly listed companies, but then there are also private companies. Although most of the time we hear about the ones that are listed on the stock exchange. What Mfunirawa, how do I benefit by buying into a company? Okay, you will get profits in the form of dividends. Okay, profits and the losses. There's some. It has been making losses, so you share into the losses. It's not that like you're going to be required to pay more money, but it also means that you can't get any dividends during that time. Okay, so the rewards come in the form of dividends. A dividend is a share of profits. Okay, the company makes a lot of money. It says, okay, we shall give out 20% of the money that we have made in the form of dividends to appease or to encourage our investors. So those are dividends. The other way of benefiting from the stock market is what we call capital gains. You buy low, you sell high. You buy shares in Umeme at 900 shillings, then you sell at 950 shillings. You have made a profit of 50 shillings. That can even come in short term. Most people go into the stock market to get capital gains. Okay. Although especially the large institutions like NSSF, most of the time looks at the dividends that they pay, that the companies pay. Although most of the short, what we call retail investors, will be looking for capital gains. What are the advantages? Number one, they tend to give a higher return, but over the long term. Okay, like I said, this is the capital markets industry. Okay, you could get a lot of returns in the short term, but statistics show that if you invested long term, you will get a much higher return than if you invested short term. The investment club that I belong to, Christlink Capital, bought some shares in BFCU in 2008. We still have them up to now, even though we were tempted at some point to sell these shares. But now we are glad that we didn't sell them. Although, if you have bought shares in BFCU, for example, you will notice that the share is very illiquid, very stagnant. It will be almost at the same price for quite a long time. But for the people that invest long, that have invested long over the years, they tend to get a higher return. Please don't take my words. I'm just using these as examples. You could invest and you lose money the next day. Don't worry. But yeah, that's the concept. Okay. It's also very highly regulated. We have just a few companies. I think there are not more than 10 in Uganda. Why? Because a lot of companies either are not willing to sell their shares or they do not meet the criterion given by Capital Markets Authority. The criterion is quite steep. Okay, they subject them to a very rigorous assessment. So not every company can list shares. Why? Because it's a very high risk. Please note, the equity holder or the shareholder is an owner. Therefore, if that company was to wind down, they will of course sell off all the assets, pay the creditors, pay the bondholders if the company has bonds, pay the bank loans, pay everyone else except you. You will be paid last after all the other creditors and all holders of maybe preferential shares, blah, 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 have been paid. So it's a relatively high risk kind of investment. That's number one. Of course, the risk of default as a result of the company failing. Number two, there's also the risk of returns. Okay, a lot of times the profitability of the company is, and you can't know how profitable the company will be, however good it might be. You will never know. They will have projections, they will have budgets, they will have strategies, but you can never know how much profits. And remember, we said that you only share into the profits if the company doesn't make profits. It is rare that it will declare dividends. Therefore, you could spend a year, 2 years, 3 years, 4 years. I have shares in Uganda Clays, and I've held them for the last 10 years, and I've not got dividends. I think I only got dividends like a couple of 2-3 years ago. Okay, so it's very common for you to have shares in a company and you don't get anything at the end of the year. It isn't possible that the company makes profits and then doesn't declare dividends. And they'll give you a reason like, because of our strategy, we have a very aggressive investment strategy this year, and you don't have a say per se, especially in these publicly listed companies. The directors will sit and declare a dividend. You don't have a say. You can't say, for me, because I have 10 shares in this company, I need so much, especially if you hold shares. So most of the time, you don't have that power in your hands. That's another risk. The dividends are also taxable. You'll be charged withholding tax on your dividends, even when they declare them. We also have a challenge in Uganda. The market is rather illiquid, very not liquid. What that means is that you see, in developed countries or other countries elsewhere, you could buy shares today and sell them tomorrow with ease, okay? Uganda, we don't have, either it's as a result of the regulation, the informal sector, the knowledge levels, the fact that we have few companies that are listed. You will find you have shares, you want to sell them, and you don't have a readily available buyer. So the market is rather illiquid. Also, we have stagnancy of prices. A company could make profits. I did a research on efficient market hypothesis, and I realized that it's very common for a company to make profits in Uganda, especially, and the price doesn't move. Okay, an announcement is made. We have made so much profit. Our profit has gone through the roof, and the price does not move, or it moves marginally. It's very common. Why? Because our markets are very inefficient, especially in our developing countries, because of the high interest levels, blah, blah, blah. So we don't have as much information out there. So people do not understand how these markets operate. Even the people that have tried to invest in, most of the time, they go in gambling. So that's another challenge. So our market is rather illiquid. That's another disadvantage. But if you have the ability and the money, it's also possible to buy shares in Kenya. We have brokers here that can help you buy shares in Kenya, or in Tanzania. Tanzania is not as developed as Kenya, or in Rwanda, or in UK, or wherever. But remember, please don't, high risk. Okay. There are other equity securities. We've talked about publicly listed securities. There are others that are, for example, private equity. Private equity, you're buying ownership or stake in a company that's not publicly listed. You're buying shares in Fathom Associates or Gemstone Finance, but it's at your own risk. Most of the time, the Capital Markets Authority does not regulate. That's why I said we limited our topic today to companies that are regulated by the Capital Markets Authority. So, sorry, to securities that are regulated in nature, financial markets that are regulated. So it's very, very possible that you could lose quite a bit of money. So yes, I was talking about private equity. You could buy ownership in a company that's not listed. Your friend has a company that they are running and you buy ownership, but please note, it's very, very high risk. You have to know, you have to do your due diligence. Unlike even the stock market, by the way, you also need to do your due diligence. What do I mean by due diligence? I think I didn't put a slide on that. You have to understand this market. You have to know, where do these guys invest? If I'm buying shares in DFCU, what is the strategy of DFCU? What is giving me that assurance that DFCU is going to be in existence for the next 20 years? Because remember, you're investing long term. that they're going to be making profits, that their profits are going to be growing, and a lot of some of those other things. So it's very critical that you do your due diligence. There's what you call fundamental analysis, where you look through the company's financials. You can get companies that are listed, you can get the financials, the annual report or the financial statements. You look through them if you have the capacity. Most people don't. That's why we encourage that you maybe need to get an expert to help you go through the financials. They assess, they say, okay, this company is overpriced, this company is underpriced. That's what we call a fundamental analysis. Okay, you need to do your due diligence, understand the company that you're investing in before you put in your money. Don't be a gambler. That's what I encourage. Understand what you're investing in and therefore make a wiser decision. We bought shares, like I told you, bought shares in Safaricom. The price went down. A lot of gamblers were discouraged. They sold their shares. And as we kept buying more, when the price went down, we bought more. When it went even lower down, we bought more. Suddenly, the company started to rise, okay? It went above the IPO, it doubled it, it tripled it. And the people that had sold when it was down, they lost money. Why? Because they gambled, they got discouraged. And please, when you're investing in the stock market, the GMO feelings, don't put emotions, okay? If we had time, I would have told you my story when I put emotions in investing in the stock market and I lost with flying colors. Okay, that's all I think. Going to other matters, A or B, please get started. A lot of things that we have shared today might sound like stuff out there, especially if it's your first time to hear them, but it's actually not hard. It's very, very simple. The financial markets are very, very simple to learn, even for anyone. But the thing is, are you willing to learn? And learning is faster when you're acting. I started investing in the stock market when I was at campus, okay? Right now, if you've never started, even if you have a master's or a PhD, you can't build the amount of knowledge that I've got just because I acted. Not because I've studied it, but just because I acted. So it's good to start with a small amount of money, and then start to grow it. And then you hit, then you lose money, then you do what? And that's the best way of learning. And I keep telling people that in business or in investment, loss is tuition, okay? I don't think any of you has paid for this session, okay? You probably haven't. The best way to pay is to act. If you lose money, then you have paid tuition, and so you do things better. Number two, please, let's regulate our return appetite. Like I told you, a lot of us think that financial markets give little, okay? Why don't I invest in real estate? Maybe I need to build apartments, blah, blah, blah. Most of the time, you go into real estate thinking it gives you higher returns, and you lose it. You forget that there are also higher risks. You put up apartments and then people run away with your money. I'm not saying don't do it. I'm just giving you scenarios. People run away with your money. You invest a lot of money. Even the return is not as high. Why? Because we're looking for high returns. In Uganda, we have that problem. A lot of investors are looking for things that return very highly. I think we need to regulate our return appetite. Like I told you, investing 100 consistently for 20 years, you'll have 67 million shillings, about 67 plus, just because you invested at just 9% per annum, okay, in a simple unit trust. So please note that we need to be very, very careful. A lot of us are either, I don't know what it's called, greed, but I think we need to regulate our greed. Number three, we need to have a strategic plan. Even you as an individual, even if you're investing as an individual, a lot of us don't have a plan. We just investment, you just say, okay, I have some money, you put it today, you remove it tomorrow, you put it elsewhere the other day, you lose 50% of it. Next 10 years, make it long term. Over the next 10 years, I want to maybe have accumulated 100 million or 200 million. It is very possible because you have done it consistently. Okay, like I said, please have a strategic plan and make sure that you have goals, make sure that they are smart. At my time is fast spent, make sure they are smart, specific, measurable, attainable, realistic, and time bound. Okay, make sure that your goals are clear enough. Okay, there's that thing that I want to close with, that picture. It says doing nothing at all versus making small, consistent efforts. Okay? Imagine if you got $1 and you kept it for 365 days, you will still have $1. Why? It is because it's 1. But if you invested $1 is 3,000. If you got $1 like this and you invested it only at 1% over the next 365 days, 1% per day, okay, or whatever, you'll have $37.7 at the end of that 365 days. Just 1%, 0.01. 1.01 to the power 365 is 37. That's the difference of small, consistent efforts. It doesn't make sense to try to leap huge or to jump big gaps. I think let's start small and be very consistent. And financial markets are the way to go if you're going to be disciplined and to be consistent. That is all that I had to share. My time is fast spent. Actually, I've exceeded. Back to you, Anne. This is information about us, about Fathom Associates. We do personal financial management training. We do business and strategic planning. We do outsourced accounting services. If you have a business, you don't want to hire an accountant, we can do your accounting for you, prepare financial statements, and then bring in the